Good evening, everybody. We are extremely fortunate tonight to be able to have a conversation with two people who are got a tremendous amount of experience and are right in the thick of things, and will be able to share with us their experiences and thoughts. And we want this to be a very informal conversation. So I'm going to start off with a question. I might have a few other questions as we go, but as soon as they start responding, feel free to ask some questions yourselves. If you can try to stay on the same topic a little bit so we don't wander all over the place.
We're not going to talk about global warming, right?
We talked about global warming
please.
here, not
Well, let's have a go.
Oh, let's go ahead.
Let's go.
General Electric, we might have to talk about global
Might
warming.
have to talk about global warming.
Let's have a shot. Yeah.
Elyse Allan is President and CEO of GE Canada, and Don Wilson was Chief Risk Officer at JP Morgan Chase most recently, and he's had a long career at JP Morgan Chase, and Chemical Bank is where he actually started. Elyse has got a bachelor's degree from Dartmouth College in environmental studies and biology, and she also went to the Tuck School and graduated, I think, in 1984, which was the second year that I was here, actually. So I didn't have her in class, but we did overlap a little bit. And Don graduated from school down in the Charles for undergraduate. Harvard will forgive him for that. But he wised it up, and he came to Tuck for his MBA.
Well, the great thing about Cambridge is that communism is coming back, and it's no surprise that there are a lot of Harvard guys in Cambridge, in Washington right now.
This should be a fun evening, as you can tell. Both of them are
look like a free market.
both of them are great friends and supporters of the Tuck School. They're both on the board of overseers, and Don is chairing a very important committee right now, which is Tuck Annual Giving. So be nice to him on that front. So.
I wonder you were hitting me up for money earlier already.
You got to go where you can find the cash.
So, we probably want to talk pretty much about current events. So let's just broach that one right away. Boy, if you listen to what's going on, you listen to the pundits, you listen to the politicians, it looks like we haven't seen times like this since the 1930s. Just tremendous things going on. The Russian stock market was closed again today. A lot of Eastern European fears. Japan's GDP fell, I think, at a 13% annual rate in the last information. There's news coming out of Eastern Europe that sounds really bad. I don't think we've seen Western Europe quite hit bottom in any sense yet. I think we've got a lot of bad news to come out there yet. So have we really not seen times like this since the Great Depression? Is this really different? And maybe Elyse, you can start it, because you're in an industrial company. GE is obviously in all these world's markets. Are things as bad as everybody's making it out to be?
Well, I mean, I think to answer your first question, I think these are very unusual times. And yeah, I think they're rivaling the 70s. And the question is, if you go past the 70s, there's not much until you hit the 30s in terms of similar types of situation. The question is, will we do that? Our sense of it is that there's probably another $1 trillion that has to work its way through the system, and I'd be interested what Don thinks about that. But, which means we're not close to sort of seeing the bottom of this yet until a lot of this works through. But in the spirit of always trying to see where the opportunity is, while we can look at all the numbers, and I think everything is exactly as you say it, that doesn't mean that there's not opportunity. And I think what's interesting is our chairman, Jeff, was just up with me in Canada last week, and even he was commenting that the Canadian market and talking to the customers was a very different feel than what you have on Wall Street and you have in the United States. And he had just come back from a trip to India and the Middle East and Africa, and I think he said really globally, every place feels a little bit better than actually being in New York and being in the United States. So while this is kind of the epicenter, everywhere else is suffering, but it's not suffering quite to the degree. I mean, the UK and Europe has had the same financial crisis in terms of the banking industry and the financial industry, and Don, I'm sure, can comment much more to that than I can. But other countries like Canada, like India and many others, Brazil and South America, are suffering the economic crisis that's resulted from the US slowdown, but not necessarily the same financial crisis. And that is helpful because we still have a working banking system. We don't have the hand of government running our banking system, or other companies for that matter, at least not yet. And so there is still business to be done. And that's true in a number of other markets, not at the degree that it was, but it hasn't stopped. The big question is the financial side, and I think for that, Don, I give it over to you in terms of the ability to work, for the system to work through this trillion, if you agree with that.
A couple things. I agree with you on, I totally agree with you on the difference in tone around the globe. And you have to ask yourself, to what degree is the perception that we all feel a consequence of London and New York in their respective communities being the media centers for those countries? If you came from Mars and your only consumption about economics was CNBC and Bloomberg Radio in the morning from 7:30 to 9:30, you might conclude that we collectively, we globally, are literally on the precipice. I don't think we're literally on the precipice. That's sort of point one. Point two, I think it is dangerous to, history repeats, it rhymes, but it's not the same. It has a rhyme to it. And I think it would be dangerous to even begin to think that whatever we are in the midst of now will have many of the same attributes as 1973, 4, and 5, 1931 to 1937, or 82, or long-term capital, whatever. Pick your recession or financial crisis. I don't think what we are in the midst of now will look anything like what we can look back to historically. And why do I say that? From an American and I think from a British perspective, what we are in the midst of now is simultaneously occurring when everybody is leveraged. Governments are leveraged, individuals are leveraged, the financial industry is leveraged. There was not that degree of leverage in the American society in 73, 4, and 5. Much different environment. The issue then, it's easy to make it seem plain and simple, but in hindsight, it was really someone with Paul Volcker's backbone to say, excuse me, 20% inflation is unacceptable. We are going to crunch it, and it's going to be hard, and then it's going to be over, and the money will then have reasonable value. Okay? And people and companies can actually do discounted cash flows on an assumption of moderate inflation. So that was a painful but relatively quick fix. I think what makes this environment so perniciously difficult is that, first of all, it's happening simultaneously in the real economy and the financial economy. And we're seeing all financial asset classes, at least in this country, with the exception of U.S. Treasuries and gold, all move in the same direction at the same time. Same direction, same time, in size. So I think that makes the challenge much more difficult. And we have put ourselves in a position where if you are in Washington, heretofore, you had both fiscal and monetary equipment that you could simultaneously use to right the ship and change course and increase the velocity of activities. And we are, for whatever reason, in a situation where the only thing left is fiscal stimulus from Washington's point of view. You can't make money much cheaper. And the irony and the paradox, I hate, the Keynesian liquidity trap, because I could never understand it in business school, at least the math of it. But what we certainly have is there are buckets of liquidity everywhere. It's like, you're on that boat in the middle of the ocean and there's water everywhere to drink, but you can't drink it because it'll kill you. So we're in a very, I think, much more difficult environment than we've been, at least in my career, through a variety of economic as well as financial catastrophes.
So
I think that the answer on the trillion is that I think that we're now in a position where it's not just what the number is for the U.S., it's what the global number is, and I don't know.
So if you look out in the world right now, and I hate to just focus on, on the pessimistic side, but there was another alumnus I was always talking to over the last year, and I'd say, well, have we hit the bottom yet? And he said, well, no, there's these things called monoline insurers. They still have to go. And then, no, there's the Alt-A's, they have to go. And there's, so if you look out in the world, what might still be out there to go, so to speak? Where do you see some risks that are most on the forefront at this point in time?
A couple things. I think that municipal and state government in America is about to hit the wall.
California.
Now, just as a general, I think it's going to be very difficult. I mean, again, anecdotes. You can say whatever you like about the nature of politics in California, but the governor needs $45 billion. It's a lot of money. Kansas is not the biggest economy in the world. Kansas, you know, you think in the back of your mind, there's not a lot of subprime loans out there. People work hard, they save their money, they're not big spenders. Kansas has stopped sending out tax refund checks because they don't have any money. Not good, it's an unusual circumstance. So for me, I have, you know, big concerns about state municipal finance. And of course, they're legally constrained because they can't run deficits. So they only have one lever. They have to sack people. Because they can't raise taxes. I mean, that's just not going to work right now. And a big source of cash flow for a lot of municipalities is property taxes. Well, how many people do you think that are paying taxes on their houses are going to say, excuse me, thanks for the bill, but the appraised value just isn't what you think it is, and I'm going to contest it. So I don't know how big that breadbasket is, but I have to believe on the margin it is not going to be an easy road for state municipal governments. Alt-A, any responsible financial, this is a hyperbolic generalization, so I'm not being literal, but I think that it's been a train wreck coming for some time, and many financial institutions, I'm sure, have begun more than recently to reserve against those portfolios. But that should not be.
It won't be as big of a surprise.
Well, it's going to be a non-performing loan problem. It's going to be a decrement to net interest income problem. But I think that some of the pain has already gone through in terms of reserving, I suspect.
So
certainly they're not going to be, they're not going to get, there will not be a diminution in value as a consequence of interest rates going up.
Elyse,
that's
can
not
you
going
add
to happen.
anything on the positive side?
Oh, sure. This is America. This is a, you know, Tim Geithner said it wonderfully. We have a lot of resources in this economy. You know, and if you were going to deal this deck of cards to any other economy in the world, I would give the U.S. the highest probability of dealing with this. Look, democracies are messy. Okay? It's not a straight line. But having lived in Japan, and this is not a criticism of what Japan has done, because it's a different situation, an awful lot has been done. It may not have been done perfectly correctly, but you got a lot of people in the kitchen right now, maybe too many people in the kitchen.
Too many people.
There's a lot of people in the kitchen trying to, you know, right the ship. I'm generally pretty optimistic. I think it's going to be painful from here to there. But, you know, we've seen double-digit unemployment before. It's not fun.
The question is a little
bit,
fun. Is that, you know, it's this interesting dichotomy of we were just doing a review of the countries around the world, and there's about $17 trillion that's been announced in stimulus packages globally. So you say, that is terrific. That's going to drive a hell of a lot of stuff. It's a certain amount, assuming that people can execute it. It's focused on the right stuff. You can actually deliver what you do. But ultimately, somebody also has to want to buy. So the question is, you American consumers, how many of you and your families are intending to spend wildly on stuff next year? And will the stimulus do that? Because we can get liquidity back in the market, and a lot of people are starting to say it's freeing up a little bit. You have some that disagree, but let's say it frees up at the back of the end of the third or fourth quarter. Ultimately, you need a consumer. And so the question is, that consumer has been America. And will us start consuming again, and how quickly, and will those stimulus packages do it? Because while we can get liquidity back into the system, and it's hard with 17 trillion and all this money going into the banks not to loosen up a little, ultimately, will people go out and spend? And what does that look like?
Well, and there'll be a lot of good PhD theses.
There already are.
Material, okay?
The American Economic Association meetings this winter.
What we will only know in hindsight is whether the American consumer will have had a material change in his or her marginal propensity to consume. In the 1980s, and it wasn't that long ago when Japan was going to rule the world, and the Americans were awful when it came to saving money. In the 1980s, the Americans saved 10%. Okay, we're saving nothing now. So if there's such a thing as mean reversion in the marginal propensity for people to save, then one could argue that it may not be the consumer that is the great engine, because remember, the consumer has financed the spending not with equity.
So that's
financed with debt.
That's a good theme. What changes do you think will be, permanent is maybe too strong a word, but quite long-standing coming out of this? Maybe we'll see a high savings rate in the U.S. for the next 10 years, 15 years. What other changes? Financial services, auto industry, oil, nature of credit, nature of the housing market. Where do you think the long-standing changes of this crisis are going to show up?
I think it's hard to imagine that the financial services industry that any of us knew going into this will ever be the same, certainly in the States, probably UK, Europe, and probably around the world as everybody responds.
It will be run differently. It will have less leverage, for sure. I cannot imagine a world that does not embrace the ability of institutions to raise money in debt and bond markets and from banks. It will be an and. There will be a public securities market and there will be a bank market. There will be less leverage.
Securitization?
Oh, absolutely. Oh, there's no.
It's already coming.
That's not no. The issue is the core issue to me will be when the regulators decide to all get in the same room together and they agree amongst themselves that they're not going to run the thing based entirely on mechanics, that they will agree on what is an acceptable amount of leverage given everything on the balance sheet, everything accounted for, what is the kind of leverage that's to be tolerated in financial, in banking in licensed institutions and unlicensed institutions that provide credit. That's going to be, I think, one big change. The second big change, I would not want to be in charge of strategic planning in any consumer business that is a product line that is marginal discretionary spending. I think every household, hyperbolic statement, discretionary spending is being reviewed by a lot of housewives and husbands and families across this country, and part of that discretionary spending may not come back.
I'm a little interested,
Yeah.
When you look at certainly in the States and
Yeah.
probably ultimately I think UK and other places where you have such a role of government that is, stepped in as owners, investors in so many institutions, particularly financial institutions. I'm a little intrigued that maybe what is your sense of that, how that wouldn't change things a bit more structurally than just
Well,
the
I think it
market
depends. I
going
think
there?
it depends who. I think that, again, anecdotally,
Yeah.
we all know what's happened to the UK banks in terms of Alistair Darling coming in and deciding we're not going to pay this guy. We're going to pay literally into the nitty-gritty
Right.
of the name by name on bonuses. Let's remember that there is a tradition of government ownership that is only a generation ago in the UK. And you can say whatever you want about the Labour government, the Tory government, and social. You can say whatever you want. There was a long-lived history of the government owning stuff in the UK from 1945 until Mrs. Thatcher. Whole generation. That was only arguably one generation ago. Even in the Roosevelt era, yes, a lot of banks were closed, but the ownership of capital was never to the degree that it was by the government in, for instance, the UK.
Yeah.
So I think that there's a little bit of social history that may take the UK and the US down different paths. I think that I said in class today, what's interesting to me, and I'm not a think tank. I don't know what's going on in all the think tanks, obviously, but I'm surprised, given the mantra of the markets over the last generation, of the absolute silence of the free market, open market, op-ed pieces on, not politically on what the administration plans to do or may do, but just, sort of the high ground on this theory versus that theory. There is no debate. There is no, we're all in a mess, we got to do fast. I'm surprised that given our roots,
there's not more.
That there's not more of, not a pushback, but just, here's the loyal opposition. Have you thought about this, this, or this? It's surprising. And maybe it's because of the speed and the intensity of what we're going through that there just isn't time. I don't know. In terms of autos, it's always the good news. It's always an unintended consequence. Detroit and Japan have gotten very good, both of them, at making cars that do just fine with 100,000 miles. They actually look good. They don't rust. The engines work. They're fine. Okay, so there's going to be a period here where people are going to hold on for longer. The banks have all gotten out of the leasing business. Okay, so we have, in my opinion, a very short-term problem of too much supply on used cars, and I'm going to hold on to what I have longer if I own it, but there will be a pent-up demand 3, 4, 5 years out that will be very beneficial for the auto industry if it has a cost structure that makes sense in terms of the proper, not the proper because that's judgmental, a survivable mix between labor and capital costs. Not near term. But long term, I don't think that the world is going to go mass transit and that cars are going to disappear. And I don't think that we're going to have $5 oil gas at the pumps for a very, very long time in the future. Personal point of view.
Questions. I'm going to try to repeat your question, so say it nice and clearly, then I'll try to repeat it.
So, given the downturn, I imagine that some market leaders may actually come out stronger, and they might be thinking about doubling down and investing through the downturn. So, as companies are thinking about that, and given the linkages between, you mentioned that the outside U.S. there is only the economic crisis, not the financial crisis.
Depends.
But are companies thinking that they should invest outside of the U.S., or are they also feeling the pressure of investing in the U.S. Sort of to get the economy going again? And how are those decisions?
So if I can try to paraphrase that, there's some companies are going to emerge strong from this, or at least relatively strong, and the question is going to be, where are they going to be looking to invest, given that there are some opportunities, as Elyse said.
Sure. And
are those opportunities primarily in the U.S. or outside of the U.S.? Or generally, where do you see the opportunities?
I would say we certainly feel that there's some very real opportunities. I talked a little bit about it in class today. But I mean, never in the history have we had sort of the rising populations and economic forces that you have from the combined geographies of India and China. And so those demographics of those two regions haven't changed during this economic crisis. You still have major populations that are looking to move towards middle class. They're increasing their consumption. They continue, particularly in China, to move towards urbanization. Yes, it's slowed from 9 to 7, from 8 to 6, pick which numbers you will. It's still, on the base that they are, a significant growth rate, tremendous population growth. And so we remain quite bullish that those consuming populations, you add in South America, where Brazil and those countries continue to be very strong, even through the current crisis on a relative basis. Add in certain parts of other nations in Africa, which has yet to emerge, in Eastern Europe, where there's an incredible amount of talent and capability there. Russia's still sitting there with so much. I mean, the world is filled with opportunity. But I think you will see a tremendous shift where, in fact, the quality of life in the United States and in North America will probably decline by 5, 10, 15 points, whereas the fact is the quality of life in emerging markets will increase dramatically. And I don't think that's going to change. And I think certainly when you look at GE, one of the smartest things that Jeff has done in his tenure so far was certainly to move us to 54% of our revenues coming from outside of the United States. Because even now, the resilience that's bringing us as a company, the economic backlog in terms of orders for new equipment and services is tremendous. That's not coming from the US market, that's coming from these emerging markets. And that's going to continue. And I think the smart companies, and I hope we certainly put ourselves there, is what we're trying to do is make sure that as we go through this downturn, we are continuing to invest in the capabilities that will position us well for those markets. That has a lot to do with infrastructure. So you're looking at your energy infrastructure, because all this consumption, all this stuff has to be made, and it all has to be plugged in. And it all requires oil. So at the end of the day, to your point, we're continue to be quite bullish that oil prices aren't going to stay in the $40 range. They will be returning to something maybe in the $60 to $80 range. You'll continue to have a demand for your resources, and your commodity base will come back. And once that starts to happen, that just drives a lot of growth in a lot of markets. For us, it drives a lot of capital equipment. It also drives a lot of consumption of water. I talked a lot with people about water and the technologies around water. And the final comment I'd make is the developing countries are just getting older, and those other populations, the emerging markets, are just getting younger. Both ends of the spectrum, you demand healthcare. And so another huge opportunity around the world is access to healthcare and low-cost healthcare. So, despite what we see in terms of an economic crisis, the fact is there's tremendous opportunity in a number of major markets globally.
If you want to invest within GE right now, have the criteria for investment changed?
No.
Is it easier, harder, the same to make the case for a major capital investment within GE?
As Jeff put it when we were together last week, I mean, the comment would be that we know we're comfortable in what we believe in. Like, we understand our view of the world as a company, and so that decision-making framework is well understood in the company. I think where, the decisions are very much different is all around our financial business. Where clearly, given the investments of states basically into the financial markets, our role as a non-bank financial institution will absolutely change. When you look at the US opportunity to be a bank or not, if we become a bank, we potentially have to exit a lot of our industrial businesses, which we're just not going to do.
You'll like those Fed reserves coming in and doing your annual review.
Yeah, so at the end of the day, we see our role as a non-bank institution in the financial services industry going down, dramatically, probably by as much as half. But the rest, the core, which is infrastructure, and also healthcare being very important, and a lot of those technology underpinnings for those are very much going to grow and continue to grow.
And there's always a silver lining, and I hate to sound like a Pollyanna, but when you talk about particularly Brazil, India, I don't put Russia in the same category as Brazil and India and China, but it's equity financed. The Chinese don't borrow money. This is equity, it's from savings, okay? Which, number one, makes it more durable and makes it less volatile, okay? That's good news for any of us or you that end up working for firms that are not just U.S. revenue operations. Okay. The Brazilians, I think, learned, as did everyone in Latin America except maybe the Argentines. It's always going to be that. They have to default every 10 years, every 15 years.
Good one.
That one of the silver linings on the crises in the emerging market world 10 years ago is that religion was received. You know, debt, offshore borrowings for local development just doesn't make any sense. And so those capital markets are incipient.
Go from Iceland down there to learn about that. Perhaps.
Well, no, that, as I said earlier, that was, Iceland is just one more step in the Vikings dealing a tough blow to the British. Okay? Yeah, it's just one more Viking invasion. All right. Remember, Iceland, with all due respect to my Icelandic friends, has a population, I think, what's the biggest town in New Hampshire? What's the biggest town?
Concord, Manchester?
How big is Concord? 200, 300,000 people?
About Iceland.
That's Iceland. Okay, so not the, you know, but you got to put it in perspective. So I think that the good news on the BRICS, I think the Russians are different because I don't think that that is wealth. There's no middle class, and that wealth is exceptionally concentrated, and it's monolithic in terms of coming from one thing. That's a problem. Yeah. You're from Iceland? I'm sorry.
Yeah, that's the Icelandic.
Okay, have a go.
The high corporate tax rates in America and the desire to leverage experience, what are your thoughts on the U.S. and the likelihood that they would potentially lower corporate tax rates to encourage less leverage?
So is there a relationship between corporate tax rates and leverage?
And corporate leverage.
Corporate leverage.
I think there is.
Well, you know, if you look at corporate America from a leverage perspective, and you take out of the analysis every sponsor LBO deal, take all the sponsor deals over here, I bet you could prove pretty clearly that corporate America is not particularly leveraged unless it's in the financial services industry or in Detroit. Mainline, unsponsored deal, unprivate equity deal, corporate America. I think the good news is going into this economy with cash and not really leveraged.
It's interesting.
I think the leverage is it's good old-fashioned operating leverage where
Right.
you're not having a problem because you've got too much debt. You got a problem because you don't have any revenues.
Right.
And that's a much different problem than, you know, biting real hard on the apple and doing a debt for equity swap and stretching out your liability. That's a much different game when you have revenues that near term go down and they stay down. That's got a much different consequence on your product lines and on your labor.
Well, and also particularly when you don't have line of sight to the end of the year and what's going to happen with your revenues. So,
Right.
I mean, the question is, how good were the balance sheets going into all this? You know, on the Canadian side, I know, you know what, they were pretty good because through the 70s and through the 80s, people really shored up their balance sheets. And our sort of mid-sized companies, and I think that's fairly reflective of the U.S.,
Absolutely.
we're in pretty great shape. And that's in part why GE is not, you know, non-bank financial services industry that does leasing and everything has been booming.
Booming.
Because you know what, when you looked at these people, they were in pretty good shape, easy to lease stuff to, pretty good. You know, staying away from sort of the big sexy stuff, sort of the meat and potatoes business, people were in good shape. The challenge is now, they don't have line of sight to how long is this going to be.
That's right.
I mean, you know, with Jeff speaking last week, we went into September with $15 billion in cash. We ended the year, at the end of December with $48 billion in cash. We are now at $62 billion in cash because we're anticipating that there's another Lehman Brothers or another challenge like that on capital markets. We have to be ready for it.
You don't want to call anybody and ask for money.
Right. Back to your question, you know, sort of what are people planning? So right now, that's what we're doing at the big. Every little guy, every mid-sized person is doing the exact same thing, right? They're just holding on because they can't quite see how long they have to hold on for. So they're just going to pull in, manage that balance sheet, manage their working capital, and operate the hell out of the company if they're smart.
I think where a sin was committed in terms of leverage that had nothing to do with taxes, there's always the negative to a positive. Positive yield curve is wonderful if you're in the financial services business. Borrow short, you lend long. Big risk, potentially, but I think that one leverage sin that corporate America made, sweeping generalization, with commercial paper rates so cheap that you look stupid by going out 3, 5, 7, 10 years in terms of your debt structure.
So a lot of short-term debt.
There was way too much short-term debt. I mean, these were credit-worthy enterprises that had ready access to 4, 5% money for 5 to 7 years, who chose 1% money overnight.
We'll claim
The issue was, and you're going to do both, and you
know?
want to do both, but you don't have to put everything on the short end. And again, things happen not so much consecutively, but simultaneously. That happened at about the same time that the biggest dealer in commercial paper went bankrupt, and so there was no one to answer the phone when you were calling to roll over $1 billion of overnight money. So I think, for me, the leverage sin for corporate America outside the sponsor business, the over-reliance on short-term commercial paper from non-bank financial institutions.
Great point.
Huge problem. Huge.
How should financial services be regulated?
Well, first of all, one regulator for everybody. We don't need all the acronyms and we don't need the OCC and the SEC and the Fed and the FDIC and the OTS and the commodities exchanges, the commodity regulators. Okay. Rule 1. That regulator should not just do banks. Okay. You need to define a financial institution without using the word bank. Okay. The biggest and best form of regulation is guidance on leverage. Put everything that's an asset, everything that's not debt, everything that's equity, understand it and have a fundamental guidance on acceptable leverage. I think that there is no question that we're going to have, the economy is going to have some understanding on the amount of outright interest rate risk that you can have in a balance sheet if you're a financial institution. The borrowing short, lending long. Okay. I don't think we need any more rules than we have. There's plenty, trust me. Okay. Leverage is the whole key.
And I think
that's the big key.
And I would also say your comment, as a non-bank institution, this whole question of what's a level playing field now, when you have so many different ownership structures, so many different hands, sort of some transparency about who's got what, and also how do you create that level playing field, to your point, because right now it's pretty unclear who you're competing against and what the rules are for them versus you, and can they be doing other things that you don't even have access to or know about? And what does that look and feel like? And that's just not true in the United States. Same issues whether in Canada, UK, and everywhere else.
Right.
So Don, there were some changes in leverage regulation over the 2000 decade.
Sure.
2004, there was one change.
One big change.
One big change.
Can you 6 institutions.
Can you comment on that?
Yep. 6 New York investment banks arrived at the head of the SEC's office at the same time. Basically said, gee whiz, we think 30-to-1 makes sense. Good idea, go ahead.
Were you one of those?
No, we're not a broker-dealer. None of the banks were there. They're not regulated by the SEC. Not a broker-dealer in terms of being the main business. If we had that issue, we would have gone to the Federal Reserve Bank and they would have said, thanks for coming by, but you can go back to where you came from.
And you think that made a big...
No, I don't know. No. It ultimately comes down to decisions that were consciously or unconsciously made by the men and women in charge of risk portfolios. Okay. Did it make the pain more painful? Of course it did. But I can't in good conscience say that more leverage automatically made it bad. It did not help. You could also say at the same time that maybe we had an environment in this country where money was too cheap and too abundant for too long. Did that light a fuse? Maybe you can say that people that should have been doing due diligence just looked at the front of the prospectus and said, well, the usual cast of characters are underwriting it, and all the right hedge funds are buying it, so I want a piece of that too. Or maybe you can say, well, you know, there was no volatility, so if you were an option writer, it was a great deal. So I think that, you know, there's too much going on at the same time to take one out. But fundamentally, men and women made decisions, consciously or unconsciously, on their risk appetites and on their leverage appetites. And we all know that when leverage cuts both ways.
I could say, though, that if you take a market like Canada,
Yeah.
where you had regulation and you had a maximum of 20%.
One regulator.
One regulator.
Thank you very much.
Limit of 20%.
Yep.
Which was, in fact, in force.
Yep.
So as a result, your risk appetite was kind of managed as well.
Absolutely.
You know,
Well, and you have a society that has a high propensity to save.
Yeah, a little bit more. And so, as a result, you end up with a very different scenario than you're ending up right now in the U.S. market. Right?
Well, because the Bank of Canada basically said, we've looked at all this wonderful Basel II stuff, and we understand all these formulas, but read my lips, you're going to have 10 or 12% equity.
Right.
And that's the way we're going to run it, and thanks for coming by, but that's the deal.
Yeah.
And it's the old-fashioned, it's not just the rule book, it's it's guidance from the regulator. And in Canada, if you're a CEO of a bank, when you go see, you don't go see the regulators, you go see the regulator.
Yeah.
So there's no arbitrage opportunity
across the
in
regulation.
choosing your jurisdiction of
Right.
coverage, which we have in the U.S. You can pick who's going to cover you. That's sort of stupid.
Here we go.
I'm from Japan, and when I look
Hi.
back, when I look at our history of the last decade, the biggest real crisis came after the financial crisis, when commercial banks tried to decrease the amount of bank borrowing to improve their self-equity ratio. And then many Japanese companies, and particularly small to medium-sized companies,
Squeezed.
bankrupt. My question is, so do you think this country may face such kind of real crisis caused by the lack of bank borrowing?
The lack of?
Bank borrowing. So liquidity problem caused by.
So looking back on Japanese history,
Right.
you're saying that what really caused the real economy to suffer was when banks stopped lending money, particularly to small and medium-sized companies, and that put them into a liquidity crunch, which forced them to shut down their operations. And do we see that happening? Well, we see it to some extent in the U.S. already.
Certainly
Well,
seeing it
How much
in
and how much more will we see?
No, I was going to say, certainly, you know, I'll speak to the Canadian market because I know Don's here. Certainly in the Canadian market, that's a great example of what has happened. And so what particularly because as a non-bank financial institution, we were, in fact, there are 5 major banks. We were the 6th largest lender. So once we had a shutdown of some of the commercial paper markets, we're retrenching from the market in order to pull down what activity we've got out there and our net assets out there. And so all of a sudden you saw that the small and medium, how reliant they were on the non-bank financial lenders. And there were obviously others like us out there. And I don't know to the extent, I think that rolled very much through the States as well. And so that's why a lot of the bank activity, certainly in Canada, the central bank activity has been how do we pump liquidity back into the market for the small and medium enterprise. And I know that's certainly been happening in Europe as well.
I think that in the U.S., that the biggest risk for the middle market customer, corporate customer, is not the potential scarcity of bank loans. 40% of the lending that is done in the U.S. until about 4 months ago was not done by banks and was not done by the commercial paper market. Those sources of funds have truly evaporated. They are gone. So you have a situation where the residual providers of 60% of the financing are being called upon to, quote, keep lending, not only just to keep up the same rate for their same customers, but someone's got to fill the gap for those sources of debt financing that are now gone. I think that the commentary that banks aren't lending is at best an anecdote. I think it is woefully overstated. I can't prove it.
Asset-backed lending.
Asset-backed lending, and the mortgage brokers and the non-bank banks.
Leasing?
Leasing.
A lot of the equipment.
Well, and by the way,
A lot of our money.
you might say that the hedge fund industry was a lender. What's happened to the assets in the hedge fund world? And that's not because they're writing them down. It's because the investors are saying, excuse me, I think I'd like my money back if it's not gated, and I'm going to take my money and buy U.S. Treasuries. This is what happens when people change their risk preferences. But you could look, I mean, it's a two-way street. Yes, asset backs were wonderful. Guess who bought asset backs? Hedge funds. Hedge funds only have two sources of capital, investors and margin debt. No value, Judge. That's just the way it is. So, but I don't think, I'm the least of my concerns is a Japan-style risk for small companies. I don't think that that's an issue. I think there will be companies in that market that will not receive money. If in fact GM and Chrysler go into chapter, it might be difficult if you're a Detroit subcontractor to get financing. Well, that's understandable. But I think that's different than automatically shutting off money for everybody. So I don't think that's a big risk in this economy.
The banks are still quite busy loaning. Certainly, I know in Canada, and the challenge is that they've got a lot of pressure saying you're not. Yeah, and they're actually out there, and they're making pretty good money right now, and they're out there being able to pick their market, certainly in the Canadian.
Someone should do the empirical analysis real quickly and go into the U.S. economy and look at the banks and take out the top 12. Just take them out. Just take out the top 12 arbitrarily. And I'd be very surprised if you saw a material contraction in lending. I mean, I don't know. But I think that we've got to be much more. See, the problem with instant news media, again, I'm not criticizing the journalists. That's not the point. But sound bites sometimes are not accompanied by what are the facts? I mean, what are the facts? But, there becomes a herd mentality when everyone believes now that the banks aren't lending. Isn't that what we believe? Okay, what are the facts? And I don't think that the facts, upon transparent disclosure, would support that. Again, one guy's opinion.
And I know in Canada,
but I'd sure like to know.
Where they have a handful of banks, there's
right.
five nationals. They actually added it up and came out because the government was accusing them of that.
Right.
In
fact,
so they came out and said, facts
guess
are,
what? We're
here's
lending.
What we're doing.
Right.
And it's just, to your point, it's just not enough. So there's a high noise factor because there's a lot of people that relied on other sources that are gone. And so they're making a lot of noise.
But you see, and it's good news, bad news. I think the bad news for Japan in that period, because I lived there then, was that there were, and there still are, in Japan, there's only one source of money. There's two. Sarakins, the money lenders, and the banks. That's it, basically. There's no bond market. There's no commercial paper market. There's no asset-backed market. So I think it's incumbent upon this financial system, as soon as we can, to resurrect all the securities markets so that borrowers have choice. No, I have a lot of time for borrowers having choice in terms of where they access money and what they pay for it.
So
and
what's interesting in economics is that's not fiscal policy, that's not monetary policy.
What is it?
It's
a doing business. What is the capitalist system all about?
It's a new kind of policy that I don't think we've had to do before, and it's emerging in
I
this
just
crisis.
let's make sure whatever comes out of TARP and whatever comes out of it, I hope at the end of the tunnel that borrowers, people that need capital, let's be even more general, that people and institutions that need capital have multiple vehicles to raise that money. globally.
In the back.
If we give that up, that's a big problem.
Yeah, I agree.
Come back to the previous question about regulations. Considering the globalization and the dynamics of this globalization,
Right.
and seeing the impacts of this whole financial crisis, is there a real will globally to fix that globally, meaning having regulations that could be actually apply to everybody and not only in the US and so on? And do you see that if that's not the case, do you see that the epicenter of finance and all these big platforms that you mentioned, that London is there, Abu Dhabi could be there, and maybe Asia, could you see a shift then if this global regulation is not happening? Because there's too many regulations, there could be too many in the US, and therefore some things would shift over to some other.
So the broad thrust of the question, I'd say, is what's the competitive landscape for financial regulation look like?
Big sovereigns, funds, and Abu Dhabi platform, and London, and Europe, and even Asia that's growing, and the confidence in Wall Street has decreased due to what happened, and if there are a lot of regulation on top of all this, then maybe the focus will shift a bit.
And what's the role for some globally centralized financial regulation, which we have quite a bit of already?
I would just say I think that there's certainly a question of your ability right now to execute that. Could there be an interest in that, or could there be some opportunity for it? But I mean, you had issues around the EU prior to all this happening about it's pulled them together in an organized way. I think but the ability to really do so much cross-border, personally, I think would be a bit questionable at this point. Although I think we'll see far more cooperation, and I think already have through times of trouble than we have before, and that could continue, but moving it beyond that, I'd be interested in your thoughts on that, Don.
Well, one thing is for sure, that the consequences of leverage, no national idiosyncrasy. Leverage is leverage, okay? That's a fact. So I think anything that harmonizes a view on a defined set of financial institutions as to leverage and liquidity, okay, both judgment calls, okay, would be very valuable. I think there's always a risk that a market may get it wrong, and maybe in 25 years Shanghai is the financial center of the world. It might be. But whenever people have had those comments in the past, they always forget to realize that there is a huge infrastructure that supports a financial center. Contract sanctity, the legal profession, a central bank that has a discount window that can open size and fast. The whole communication the whole thing, that it's not just the marginal tax rate. I mean, the financial services industry, as London is finding out more than New York is right now, how valuable it is to their economy, and how bad their economy performs when the core industry in the country is sick. Okay. Thankfully, in the U.S., as bad as it is, the financial services industry per se does not run the U.S. In fact, you could argue that there's no one industry, except maybe the government going forward, that's going to be the dominant player in the economy. That's a source of strength.
That's good.
Okay? It's not true in the UK. And the Canadians have run their financial system in such a way that A, it's strong and stable, and B, it doesn't run the economy.
Yeah. And when you look at a GDP, equally diversified like
Absolutely.
the States.
Like Wall Street in general, telling how Moody's has classified different AAA rated countries in 3 boxes. So the first box, it has like stable countries like Canada, Germany, France, and the second basket, it has like resilient economies like UK and US, and the third, it has like maybe it has a negative view on that, like having countries like Spain. And then there was a talk below telling that if the US keeps on like having large fiscal deficit, there's very high probability that Moody's may do a review of the AAA ratings on US. Do you think that's a possibility?
Sure.
Will Moody's downgrade United States debt?
I think if the numbers point that way, that they'll do it.
think the United States would default on its debt? Not through inflation.
Certainly won't
Actually
default if it's a
default.
double A. I mean, if it's going to default, it's going to be in the, single B, C plus category. We'd really have to screw things up to get that far along. If you're going to default, want to play real hardball, it's really good to default in your own currency because you can just print more and pay it off. Well, that's true. I don't like it, but that's the facts. We don't have any foreign currency debt. Would it be in our self-interest to do that? Of course not. It's not going to happen. Not going to happen. That's one thing in finance I'm certain of. Might be the only thing.
There are some, I mean, the credit default swaps, I do think, show some probability of a default even for U.S. debt.
Sure, because there's not a 100% probability that it won't.
And there's a possibility of some technical defaults if they don't raise the debt limits. And there's those kinds of things that could be indicating a higher probability of default, I think, than most of us would hope there actually is. But questions?
Yeah.
You mentioned before oil coming back to $80 a barrel. What other indicators might signal that this is the end of the tunnel? House prices stabilizing, or
The end,
Just the end of
the
it.
end of the tunnel being the end of low prices or the end of high prices? The end of the oil price crisis, or what?
I think if we all knew that, we'd be quite excited, wouldn't we? And a lot richer than we are. But I mean, our sense is that when we look at sort of our beliefs, right, about the underpinnings of certain economies, whether it's in 6 months or whether it's in a year, we're sort of planning in terms of our technology innovation and our focus of our investments, is we want to be there. And we expect that when you have these populations, as I mentioned earlier, putting in their increasing the way they are, increasing middle classes, which are continuing to grow in these burgeoning economies and re-emerging markets, really, that all that puts pressure on oil. When Mr. Tata comes out, with his car for India, and everybody wants one, and it puts continued pressure all on oil. And so does all the power generation demands. Particularly if the U.S. doesn't figure out coal gasification, it certainly doesn't figure out, and we don't have coal gasification technology, maybe still hesitancy around nuclear. You continue to put pressure on the oil and gas market.
Right. Nuke.
Whether it's 80, whether it's 60, but we just don't see it quite staying where it is. We think there's just too much underpinning of demand in the longer run from these economies.
Which indicators might signal the end of the general
Financial crisis?
and economic crisis?
The financial crisis.
So what pieces of good news are going to drive the Dow up to 14,000 again?
Well, I don't
Or at
think
least that's
I don't think that the Dow being driven means the financial crisis is over. Okay, I could see the financial crisis over and the Dow flat for 10 years. I think they're disjointed. I think the financial crisis is over when big banks have common stock that trades at or above book value. Number one. Number two, when credit spreads in the financial services industry mean revert to AA. Okay? And when a few banks start raising their dividends. The last one's not really an indicator of the thing being over. First two are. And I think the financial crisis is over. Because if banks can raise at AA prices intermediate term debt, that means that that means that you have a healthy commercial paper market, you have a healthy bond market, that means the asset-backed markets are alive, which means people have wide choices for funding themselves, and there's liquidity that is not government mandated, okay? Then I think the financial crisis is a game, set, match. Now, there was no financial crisis in the US in the 1950s. Zero. There was no financial crisis. Equities went nowhere. Zero. And there was no inflation. Economy was growing. No war. From 52 to 60, there's no war. So don't assume that the end of the financial crisis means that this is a growth economy. We could have no growth and not have stagflation. Okay? So in the real economy, I haven't a clue. Because for me, the biggest not having a clue is I just don't know what the forward value of the American consumer's propensity to save or spend is, okay? And that's been the big engine, GE doesn't need that necessarily because 54% is overseas. Jamie doesn't need that because 50% is overseas, okay? So those that are diversified and have been global and have a lot of eggs in a big basket are going to have the best shot at creating value if they can manage it, if you can execute. Great companies like GE know how to manage stuff. And they're diversified.
I think that's an interesting point to talk about now, which we haven't talked, just moving a little from the economy, is when you talk about operating companies now, we talked about one is their access to liquidity. What's going to be more important than anything for companies now is the ability to execute plan. Those people who know how to operate,
do stuff,
really operate a company and manage it in this type, manage their supply chain in this type of economy, manage customers, find customers.
And do it globally.
Do it well, do it in whatever market they even currently serve. It's all about execution right now. You know, we have just doubled down on, you know, if we met, you know, monthly for operating meetings, we're meeting weekly. You know, if we met quarterly, we're meeting monthly. I mean, it is all about tightening the screws and knowing exactly what's going on so that you are totally flexible and robust within this current economy and on top of it.
If you can execute in an environment where you cannot raise price, you can't raise price, and you have to reduce leverage. Right? Those, I mean, big picture, those are the two things that are going on with every business leader anywhere in the world right now. There is no premium on leverage, and you can't raise price fundamentally. Okay? Now, you've all had linear programming in management under uncertainty and decision trees. Let me tell you what. If you can perform and create value when you can't raise prices and you can't leverage yourself, you're pretty good.
Oh.
No, you win.
If
well,
you can
you
do that.
win. No, if you can do that, you win big time
that.
now. And then can you imagine what you do when you can get some price relief?
Right.
And you get some leverage relief? Just imagine. Okay? The good managements will do precisely that, and they will be spectacular equity values, intermediate term. Spectacular.
Elyse, let me just ask you a follow-up a little bit on that. How does a good manager handle layoffs?
Yeah.
How do you manage layoffs in this kind of an environment?
Well, first of all, I think you do them. So, I mean, part of it is making the decisions. I mean, a lot of times now, you have to be moving fairly quickly. You have to know what decisions you have to make, and you have to know your operations and what you need to do. So you don't wait for the orders to come in, you assess your market. And the fact of the matter is, when the market is in the situation it's in now, you know that you're not getting the volumes. You have to make the decisions. You do it right, you do it compassionately, you work with your unions on it, but you don't not make the decision. And I think the more expeditiously you move, I think what it's all about is, and we talked about it in some of the classes today, is keeping your company safe. I mean, right now, more than anything for our shareholders, we have to protect our company and get through this situation and come out a strong and viable entity at the other end of it that is well positioned to seize the opportunity that we know will be there. So we want to be investing where we can. We want to be sort of taking out the weak within our own company if we haven't done it yet, ensuring that supply chain is in place. We're loaning supply chain money. We're financing supply chain. We don't want our supply chain to go away. We want to make sure, in fact, that when this market comes back, we're actually ready to go. So you have to pick your spots where you bet, and that's where we talked a little bit about earlier, about knowing what you believe in. Like, you know, from a decision, we have to have a framework for decision making in 120 countries around the world where we do business that allows us to independently make appropriate decisions for those countries that in fact reflect the same set of beliefs about what's going to happen in the world, the same underpinnings. And that's what we're doing. And we have to make sure that we're running the operations within this decision framework, and we're running it really quickly. We're making more decisions in a day now than we've made before, because we have to. We have to make decisions daily about supply chain, daily about our priorities, daily about investment decisions and prioritization of investment decisions, while at the same time building cash. And when you think about a year ago, and Jeff was laughing about this last week, he said, who would have thought a year ago that we had growth playbooks, that's kind of our four-year planning activity, that would anticipate the capital markets may fail, and we're going to have as much cash, 60 billion plus of cash on hand, ready to go. Or in fact, we could be shooting into a growth in infrastructure in certain markets. And we have to be flexible enough in our decision making and our operating capability to move immediately in either one of those situations. Mm-hmm. And that means really knowing your business, knowing your priorities. And so it is a great time for people actually like GE, because we're a good operating company, and a lot of people who don't know how to operate, they simply will not make it through this tough time. They won't have the flexibility, they won't be robust, and they won't make the decisions, be they layoffs, investments, changes in direction, or shedding stuff. So many people don't want to let go of stuff they've had. Part of what you have to do right now is know when to shed, make that decision, and do it.
I also think we're entering potentially an era when equity capitalization in the markets will pay no premium. In fact, we'll give a discount for volatile earnings. And the market will be willing to pay for more certainty. We'll pay nothing for volatile earnings. Pay nothing, which it has not. I mean, the market's been willing to pay on the upside. Okay? I think that any capitalization that one may have had by fast-growing but volatile earnings, you're not going to get a PE for it. It's not going to happen. Not going to happen. Question?
Yes, we're talking about it. I'm wondering who you think has done a better job managing the company into this down cycle. Jeff or Jamie, you got to pick one. And given the same fact set at the same timing, what do you think the better decisions could be made?
Question is, who's done a better job running the company into this downturn?
Well, I'm not going to go near that one.
You first.
This is JP Morgan versus GE.
Well, I guess if you were being a real technician about it, you would say pick a starting point and who lost the most market cap. And I define market cap as bonds and equity. I don't know the answer. I think both of our firms are lucky to have both of them in charge.
Yeah.
That's my view.
Perhaps done things differently with the same set of facts in retrospect.
If I were Jamie. I wouldn't have changed the price I gave Bear. I would have stuck at $1. No, I don't know. I think he's done it. I mean, he's played the cards pretty well. And he's the first to admit that it was a team effort. But I think it's the old story in the financial services business. If the government calls you, if someone calls you and asks you for help, you're in a good negotiating position. Now, the firm put itself in a position where he would be one of the few people you'd call. And I think that, the numbers speak for themselves. He's also the first to admit, don't judge me yet, this ain't over.
Yeah.
First to admit, don't be so quick, don't even go there. This is not over. Let's only do it in hindsight. And, I have to agree with that.
I think that's pretty important.
I think I have to agree with that.
I don't think anyone has real line of sight to where this is going third or fourth quarter. You can have one article that says we're going to be at minus GDP and this is going to be going for 5 years. You can have another article, same page, that talks about, GDPs will be going up by the end of the year and liquidity's coming back and, 2010 is going to be great. Well, if I don't have orders coming into the plants this year, I can tell you 2010 is not going to be too good next year. So, But I think Jeff, Jeff, I think would comment about the financial services, and he's certainly working hard on the commercial paper. I think your point earlier about sort of how much commercial paper do you have and how are you doing that? In the market and the environment, I think everyone looked and thought it made sense, but I think, as we start to look in hindsight, what could we have maybe done better? I think, there are some interesting comments around that.
I think they're both great leaders,
Yeah.
but I also think that they've got, and I've never seen them together. They've got different, career paths, but I think that where they're very, very much the same, and it goes back to what I tried to say earlier. I think that they understand that it is a difficult proposition to deleverage and to endure revenue challenges and to make difficult decisions on product lines and markets and people without putting any of the franchises at survivability or, more importantly, flourishing risk. I think that's where they're both exactly on the same wavelength. They get that.
You talked about some of the initiatives that Jeff has instituted during his tenure at GE, and it seems like GE is on the right track. I think the consensus among his peers and academics alike is that he's a phenomenal CEO and the right person for the job. Mm-hmm. But it doesn't seem to be shared by the likes of Bill O'Reilly or other folks. Barron's in particular came out with an article the other day and just isn't reflected in the share price. I was kind of curious, where do you think the disconnect?
We went this long without a question on the stock. I was shocked. They usually come a lot earlier. You were too polite.
Why doesn't
no one's asked you about the dividend yet, have they?
Why don't the markets show GE a little bit more love?
Yeah. And I think, we were talking about this last week
everybody.
with a lot of the pension funds and investors. And, the fact is they continue to treat us, they look at that financial services piece, which was a big part of the company, and it's given us a huge discount. I mean, if you look at our industrial business and you look at the volume we have, the growth we have, the margin, the earnings growth from the industrial side, and you also look at the backlog that we have. We're looking at a $170 billion backlog on that. What Jeff was saying last week, we're looking at a $15 or $16, dollar stock just on the industrial side.
What's your trailing PE? At $15 a share, what's it? Don't know. Okay.
But at right now, what we're 11 or whatever it was today, and that's just this huge discount on the financial services piece. So that's why you see he's taken tremendous action through fourth quarter and into this year on that financial services piece. We've reduced commercial paper requirements. I think it's about 30%. We're going to move the financial services even higher than that, right? About 40%. And we've going to be probably reducing the size of the financial services business at least by half. I think he's come out by saying, if not more than that. The real estate side, tremendous action on the real estate side. So I think he sees that, from us, if we're not willing to be a bank holding company, which he's pretty much made the decision that we can't be given the way they've structured it, then we just can't be in the financial services business the way we were in it before. I think to the company's credit, a lot of this pretty sexy stuff that was out there, we weren't into. We're pretty conservative.
Not a subprime lender.
Yeah, we weren't subprime, but I think in terms of also the types of sexy stuff that was out there, and we weren't in all this stuff. And so as a result, we didn't take on the same risk, but the fact is, that's not helping us right now with the analysts. So, those of us that have been in the company a long time, like I have, we don't understand it. Those of us that really know the company, you look around at the value on the industrial side, the technology side, and you see where the market's going, and you don't know where it's coming from. It's really hard to explain other than a complete discounting on the financial side. And you're in that market, so maybe you can shed a different light on it.
I think everybody's getting painted with the same brush.
Yeah.
That's why I ask about the PE, because I don't know the mix of revenues and earnings, but I suspect if you disaggregate, you probably find out that the financial services stuff is getting a PE of about 4.
Yeah.
And the rest of the stuff is probably getting a PE of 15, and weighted average, that's what's going on. That's just.
It only got worse as the situation became worse.
I only follow the financial services industry in terms of, in terms of insiders buying. Have the GE insiders been buying at these prices, the stock?
Yeah.
When the windows open?
Yeah.
Yeah, good. I like that. It's good.
So Elyse and Don,
It's a good indicator.
you've had long days. We've got Don occupied tomorrow here still.
They wouldn't let me have any drinks at dinner.
Oh my gosh.
I'm in Hanover, for crying out loud. You're supposed to, what do you do at night here? You're supposed to have a cocktail.
So thank you both very much. This has been great. Really.
Hope it was useful for you. Thank you.
Thank you.
You're great.
Yeah.
You, really,
I
you're
learned a lot from
terrific.
you.
Thank you. I like you. It's good.